And good day. This is the Eye of the Storm podcast with the big picture technical update for the NASDAQ 100 and the S&P 500 with an overview also of interest rates as it is applied to our equity markets. I'm going to start here with the NASDAQ 100 and basically start to break it down. As I've been telling you during my other updates, I have been spending a great deal of time on the bigger picture, on the longer term counts. And I really wrestled with what and how we are to include and adapt to the fact that we did have very significant triggers via the SVEG breadth thrust indicator. And you can go and you can look this up and you can see that over its history, and this goes back several decades actually, that each time of the last 17 times that this indicator was triggered, it has had a 100% accuracy rate in predicting that equity prices would be higher 6 months to 12 months out by between 15 and 25% from that trigger point. Now, the first time it was triggered was back in May. And I believe it was either right here or it was right here, but it was triggered. And if we're thinking that it was triggered, let's say at 14,500, then, we're considering that 25% is 3,600 points. So we're already up basically above 18,000, right? If I add that back in, 14,500, you're looking at 18,125. That's quite a rally, but it was triggered again here on the CPI. Actually, that was right here. Sorry, just go back a day. On the 10th of November, it was triggered again, where we saw 17 to 1 breadth market, advanced decline. For every 17 issues advancing, only one was declining, and that's in the New York Stock Exchange. That's where this particular indicator pulls its data. Now, that is not to be ignored, and I know I've talked about it a lot, about not to be ignored. Then what also fueled additional rally was now that CPI and the PPI basically came out, more the CPI, that the narrative switched, the Fed's done, no more hiking, We're going to start to lower rates now. And that brought in another round. Get in while the going's good. But actually what we saw was a lot of movement in the bond, in the treasury markets, where institutions, large traders, just anybody trying to lock in yield. So we saw a lot of buying in the bond market to lock in yield. Now, that's kind of calmed down for right now because, in all honesty, the Fed has not made a definitive statement that, nope, we're done. Inflation is now under control, and et cetera, et cetera, et cetera. So that's not happened yet. So we don't have anything. It's a narrative. It's analysts, putting it out there into the marketplace for whatever their reason may or may not be. Now, how do I want to focus and put that in to how I'm looking at account? Well, that part I actually don't. But I cannot ignore that breadth thrust indicator. So taking a look at how does that change in Elliott count, it could possibly. And so that's what I basically spent a great deal of time doing, rolling back and forth into, well, first of all, what are we doing now? But in order to change that, I've got to back it up, and I'm changing prior to January of 2022 when these markets topped out. What does that do? What does all that look like? I rolled back again to the pandemic. And what if I need to change that? What if that changes the account moving forward? What then? I went all the way back, folks, here in the NASDAQ. I went back to the dot-com crash. And that was 2000, 2001, 2002, 2003. And so just before I step back in time, I want to just take a look right here at our daily chart so that I can show you that what I did end up doing is, yes, I did go over this many, many times. And even though by definition put out by Prechter and Elliott Wave International, they put together a very long list of what the rules are for an impulse wave, what the rules are for a triangle, diagonal triangle in particular, and what guidelines also go in there. And this diagonal triangle that I had labeled it as such and put an intermediate wave 1 down there actually still is valid. Now, what changes it is the intensity of this move. And even as a wave, intermediate wave 2, it has not broken any rules, nor has it really even broke pattern. It has just shown extreme strength as we trigger that indicator, and then also to see a large capital return back into the market. And that started right off that low that we got in October, the end of October, which was a completion point of that beautiful decline that we had. Now again, an October low coming back, right? This is October 2023. This is October 2022. So we have these October lows and the market launches up. Now, this is what it did prior. That was the launch, but it wasn't until the C wave that we started to get all that breadth indicators. We got another hike in there right in the beginning. And then again here. First one here. Now, the first one was May, but then we had two in November. One was here. The second one was here. So in essence, we've had this trigger 3 times in 2023. 3 times. Unprecedented. So now what I've done is I have marked it as the primary B wave here in the NASDAQ not being complete. And I have recounted this, which always sat as an alternate. But I worked it, tried others, worked it, looked at it, and what fits best is this particular alternate, where instead of 5 down, it's ABC, X, ABC. Because they were all, if you remember, on the diagonal, they were all zigzags, all zigzags. And so there's still zigzags. And that's how it's all marked. But I'm marking it as a minor 4th wave. Now, that also allows for the strength that we're seeing because it's a minor 5th wave. So it is an impulse move. 5th wave, part of 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. The impulses are the 1st, the 3rd, and the 5th waves. Correctives are the 2nd and the 4th. So it is an impulse wave. So it really, it adheres to our visual of what we're looking at, what we're seeing happening in front of us in the market. And therefore, it truly does cover this internal 3rd wave, which saw 2 breadth thrusts. Clean and strong. Actually 3. 1, 2, and this one. And that cannot be ignored. Now, in the context of the wave, and in the context of the market, having to now, if it's going to hold true to the 100% accuracy record of this indicator being triggered, we're looking at next May to next November for the market to be between 15 and 25% higher than when it first got triggered, which we said was 14,500. So how is that going to play out? Are we now just expecting that this market is going to keep going up for the next 6 months to 12 months? No, I don't believe so. It is just saying within 6 to 12 months out, the market is likely going to be 15 to 25% higher than where it all started with the trigger. Now that part, yes. But I've discussed previously what should happen if the market were to drop 30 to 38% prior to that thrust up and out and into that higher ground that is being predicted by the triggering of that that indicator. Could that be a part of it? Yes. So I went back and I started to look at why has this narrative about interest rates and why is the public or investors looking go like, well, they can start cutting rates, bullish, other than going into lock a rate and buying a bond future or just buying a treasury note or a treasury note like the 10-year. You could lock in an interest rate for 10 years. So I'm seeing that, and every time we start to get a little bit where it's like, market's not really going to do well, they do step in as buyers. I mean, there's a definitive strong bid all the way up and down here. Now, unless interest rates continue to go up, then I don't suspect that strong bid in the treasuries is going to really falter anytime soon. If we start to drop and we get into really dangerous territory where the Fed is now getting enough information that they indeed are going to raise the rate, we're going to see some strong moves in the treasuries. But let's just take a look at what has happened. So the first thing I really want to go back here in this NASDAQ and take a look at, and I got to pull all the way out to my maximum chart, and I'm looking at this period right here. This was the .com blowout massacre. And as far as I'm concerned, in the NASDAQ, particularly the NASDAQ 100, which is what we're looking at, this was a crash. It wasn't just a bubble bursting. It was a crash. Now, what created or what caused this .com bubble to burst? But we can start with saying that capital began to dry up. So in the years prior to this bubble, there were record low interest rates. And the adoption of the internet, in other words, like when everybody started to embrace anything related to internet and internet commerce. So we saw the router companies, we saw Cisco, we saw Sun Micro, which has all been taken over. We saw Intel, Microsoft, JDS Uniphase, just naming a few, Juniper Networks, Broadcom, all of these companies that were all connected to the internet just come into play and absolutely explode. Then we saw that as interest in technology, these companies allowed that capital to flow more freely, right? Record low interest rates, lots of capital available. A lot of the startup companies received huge amounts of financing. And we're talking about this. I can't remember a lot of the names that just made it about a day and a half and then just got sunk. But when they went public, it was crazy. Everybody had to jump on. You talk about initial public offerings. Back then, it was nuts where it would come out and on the first day would be jumping 100 or 200 or 300%. So that was because they were able to get the funding to move forward with basically no track record. So again, even if we were to jump quickly out to here, not because I'm going to stick with this and I want to show you something. This was the great financial collapse. Now, what caused that? Basically, real estate loans being handed out to people that could not afford it. And how quickly the property lost value and was now underwater in terms of the value of the home to what was owed on a mortgage. And things just began to unravel and people walked away from homes. Now I'm going to fast forward to something that I continue to mention, but still doesn't really get a lot of play. What are we seeing in the commercial real estate space? Now, wherever you happen to live, you need to kind of check out your downtown, check out the buildings, check out the vacancy record, check out how things are coming into play now. Is downtown recovering? Are the building values beginning to recoup? Are the lease rates in this getting back towards 100% occupancy? I live in San Francisco. San Francisco, I'm sorry to say, because I love the city that I live in, I spent the majority of my adult life right here, is not doing that well. They have hopes. They have a lot of things that they want to try to put into place. But right now, there are buildings that are selling, but they're selling at 50% discount to what they did with the current owner of the building where they purchased it. They're trying to unload it 50% less than what they paid for it. So we're seeing those values come down. We're seeing a lot of real estate investment groups that went and they bought hotels, they bought the buildings. They need to refinance these buildings because their loans are coming due in 2024 and 2025. And that's not going to happen. So they're walking away. They're just letting the lease and the mortgages go back to the owner or go back to the mortgage holder. So there is a large problem brewing over there, and it's not getting a lot of notice publicly. Now, what could that create? Here we saw this was basically triggered by retail. We're retail, common people buying homes, paying more than they should have, and receiving a loan on it when they actually likely didn't qualify for that size on the interest rates. So when interest rates start to move in any direction, it's really going to tip a scale over. So now what I want to bring into this conversation is we're going to be looking at this. We're going to be looking at this. We're going to see what the market does in terms of when Fed funds rates really begin to shift around. Now here I have, actually open this up a little bit more. So, but this doesn't get any bigger. That's the problem. My margins get bigger, but this stays the same. So we have from the 60s to the 1980s. That was the magic one where we went to as high as 20. These are Fed funds. This is the shortest paper you can get. Fed funds went to 20.61 in 1981. Different situation, I get all of that. But then rates began to fall. And we have the 87 crash, would have been right here. That's August. So the 87 crash really was like at the bottom of this thing. And rates started to go up afterwards, after the crash. So did a lot of other things. The market all recovered. But then we're going to be looking at this. This is March 1st of 2000. And then this is June of 2000. And I want to go over and I'm going to look at, when did these rates top? Basically July, August, and here's August. That's when they topped. Rates topped. Oop, wrong up here. Somewhere around 6.6, 6.5%, even going out to September. And I can open this up actually, and we can pinpoint it. There we go. See, it doesn't. It only gives me 6.5. So it was a spike up to that level. So let's just say 6.5. Now, the market starts to crash. What did interest rates do? They dropped. They dropped. They dropped. They dropped. They went to 0%. Now we're looking at September of 2003. All the way down, interest rates dropped. That's October of 2002. I just move this over a little bit. And what are we looking at? 2003, March, April, May, June, July, September. So, but all the way down to October or September, October of 2002, January, September, they dropped from 6.5 to 1 3/4. And the NASDAQ was crushed because capital began to dry up. What can cause capital? That's the other thing you got to think about. What happens when all that happens? What happens when a lot of companies go bankrupt? Or it's just like, what happens when there's not enough money to go around and to really continue to push things in one direction or the other? What are we seeing when that can happen? These are the things you have to think about instead of like, oh, lower interest rates, market goes up. It started at 6.5. The market crashed all the way down. When it got to the bottom, they were at 1 3/4 and continued to drop. And then the market started to react. And then what happened? By the time we got up to 2006, 2007, here we are, July of 2007, Fed funds, 5 1/4. Now we're here. We're out to November. Here we're talking September, right? June, October, November. They were dropping. And so did the market. In fact, this was the great financial collapse started by mortgage rates, but got carried over, and we saw big bank failures. Bear Stearns in business one day, out of business the next day. Lehman Brothers in business one day, declaring bankruptcy the next day. Bank of America, very close to going out of business. A lot of small regional banks gone, bank failure after bank failure. We saw a lot. We saw the market just absolutely get annihilated. We saw the dollar and other currencies, just volatility was crazy. But what did interest rates do? While the market was collapsing. And when did we reach that low? We reached that low in November of 2008. Well, let's go down and see. June, August, October, November. A half, or actually said, let's say 5/8, approximately. 1/2 to 5/8%. And then to stimulate and get things going, they did literally drop to 0. And then we had 0 interest rate policy, right? Remember that? where we gave corporations bundles and bundles of money that to get the economy going again. So they would have money to pay their employees. So all of these things could happen. And what happened? It took a while, but the market rose steadily, mightily from 2008 up to 2020. So it did 12 years. Yep, a little bump, a little bump, a little bump, nothing to go crazy about. We just rallied. So here the market was at a low of 1,000. The year low was 1,033, we'll call it. The high in February of 2020 was 9,760. Wow, what an increase. Going back to our chart, we can look at and see, okay, 2015 interest rates did start to come back up again. But, they're starting from zero, and literally 0.15 Fed funds. And then they climb and they reach in April of 2019, 2.5. Then they drop back down to zero. And what happened when they got dropped from 1.58 at the start of that pandemic? It was a straight line down back to zero, 0.05% on March the 30th. Now, I want to take a look. March, what is this? March the 30th. We're at 0%. And so now we have the zero interest rate policy for all the way, look at that, all the way up into 2022, all the way to 2022. Yes, low interest rates. My point that I'm trying to show you here, yes, interest rates went up from 0% and we went down. They continued to go up and we went up anyway. Right? Companies are doing great. Everything is just going along just fine. Higher interest rates not really affecting. That's not always necessarily true. So do we start to believe, okay, rates are going to go down? Rates are going to go down. Different period of time. The market deflated. So when they talk about a recession, when they talk about that we have inflation, should we now have deflation? Believe them. Why? Well, because things are overvalued. And we're going to start to see it come out. So why would the Fed really aggressively start to cut the rate and bring the rates back down? Well, when the time to really kind of halt deflation. So I don't think they're going to be in a hurry to reignite inflation by handing out money at a cheaper rate. So my point in here was to show markets do go down as rates go down. Markets rise, again, even when the market is rising. The rates do go down as the market is at that bad time going through a great financial collapse. They came down and came down all the way back to zero. So, rallied, market rates went up, dove down because the world got sick, went up starting in 2022, because there was just too much out there. And eventually we took the market out because it's like, okay, inflation. But it didn't seem to really catch fire all the way. Now we're sitting here. We had a breath thrust indicator triggered twice or 3 times, depending on how you want to look at it. And we're just soaring. My point here is I've had a lot of trouble having to hear that, well, they're cutting rates. They're going to cut rates. They're going to cut rates next April, May, June. And so we're jumping in now. I think what we see a lot of is just fund managers and asset managers just doing their jobs. You know, they're trying to lock in what is really kind of what is popular, what really they need to get on their books and show to their own clients. What's the big thing right now? Artificial intelligence. What could cause the AI bubble to burst? That's really the conversation I think should be out there. Are these stocks based on AI overvalued? Now, number one, we're seeing it in NVIDIA. And it's really not because NVIDIA got overvalued accordingly to what the CEO and the CFO are saying about the company and about their future. So really, what is it? Well, we saw a lot of that come in because of the options trading. We saw a humongous amount of gamma come out after NVIDIA reported earnings. So on that expiration Friday, which, by the way, part of it was today, part of it was last week, a lot came out. And then what happens on that following Monday? It was bada bing, bada boom, start hitting the stock. And that's what happened last Monday of this week. They started hitting the stock. Initially, they bought it. Then it was time to roll all of that gamma. And they did. And as they start selling that stock, which they did, now their gamma is going to have to adjust. And it did. And I have to show you just because I think it's important that we really wrap ourselves around what all is happening. Do you see that? 6.3 volatility. These were all sitting at 50, 60, 70. Earnings are out. We're heading into year end. Implied volatility has been chopped and hacked to where today, as it should, but normally I would see going into the close, which has now already happened, that this is going to hold at 30, 35 and really just right into that last moment. But really about going and trust me that we closed at 12 noon Central, 1 p.m. Eastern. But really for the last hour, that's where it was, 6.3. So they'd already diced it all to pieces. And rarely would I see it being offered at a penny. Much before, particularly the 480s, the stock was at 478. Oh my God, this would be 5 cents or 6 cents. That volatility would be higher based on that. No, didn't see it today. So is that changing? Very possibly. And it's kind of across the board in what we're seeing. So put that into play. If this is a minor 4 and we're getting up there, right? What is minor 5 going to consist of? 5 waves of minute degree. Could this internal count, be rearranged or changed? Yeah, it could. The 3 could come up here, and that show this is really huge extended third wave, which would put a 4th wave over here. Or I put the 3 here and the 4 here, and we're just basically starting a 5th. So let's start to fill that in. Let's start to fill in what we could possibly start to put together in terms of where can the fifth wave go? Well, what we do know already is that the fourth wave is in place, and so is wave one. So I can start to put the fib extensions, that's just the tool. But my comparison has always been, you always compare the fifth wave to the first wave. So here is wave one. I believe this is the correct level. Yes, it is. So I'm going to connect from here to here. Oops, I got to change that. Sorry about that. We're going to change that. Goes from here to here and then over to here. So 100% we've not reached yet. That's 16,327. That's still valid. And it actually takes us above wave three. So could it complete the whole picture? Yeah, it can. It can. But if we're considering that we're moving into year end and we may still see a lot of year end plays yet to be done, and they're going to be to the buy side versus the sell side, right now it's a coin toss. If you were trading the NASDAQ today, it was like, wow, what are you guys doing? Well, we're getting out of NVIDIA. And then we got to get out of some Apple. We got expirations today. So they may rally things, and then suddenly that Friday expiration shows up. And they make some changes. They do some things differently. So yes, it could complete it. And what would happen on top of this? Minor wave 5, intermediate wave C, primary wave B. Again, we're at that same thing. And I know you're all going to tell me I'm always bearish, bearish, bearish. It's like, no, I've really gone over and I've looked at this and I have dissected it several different ways. And I am going to be very bullish on the market. But what has not changed and how I've had to try to figure in what actually can happen, and still that breadth thrust indicator still hold on to a 100% accuracy, that we get that quick move down. And then the market is going to be in a position where if the Fed is going to start to cut, they're doing it at a point where, yes, we're re-injecting, we're putting more back in, and we're now going to relax interest rates because the market will have deflated. The market will possibly have gone through a recession, and possibly soft landing is really going to happen. Not soft landing up here, soft landing when it gets down, and instead of dropping through the floor, it holds levels, turns, and builds. So I'm still looking for all of this to happen. And then we get something going. All right. So that stays into place. So what comes after that? Well, after equality, where wave 5 would equal wave 1, the next one is wave 5 equals 1.618 of wave 1, and that is 17,676. That would create an irregular B wave. Is that possible? Most definitely it's possible. It has been possible all along. It just required what count we were going to use. So again, I've got to pull out to my 10-year chart because we got to go here. And now I've got to run just fibs. And I'm going to use just the retracement tool. We're going to go from here down to that low. And we're going to make sure that I include edit, and I'm going to include the 2 for irregular B wave. Well, the first one is 1.236. That's 18,947. Could the market really jack and go up that high? Sure, it really can. I'm not doubting it for a minute. And no, I'm not always bearish. I'm showing you. Technically, there is a level. And guess what? After 1.618, what comes next? 2.618. And that's just for the minor fifth wave. And that's 19,000. There's another where we have a cup and handle. I believe it's right here. That if you took that one and took that measurement, it's 22,000. So these things are out there. But trust me, no one is saying, oh, 100% guaranteed that's where the market's going to go. Many, many, many things have to happen before a market's going to hit that level. There has to be something a lot better going on. So there's so many things that go into it. It's just not going to run just because. It's going to get caught up if it were. But I am looking for additional upside. And it starts at 16,327. And then we're going to 17,440. And then 17,677. And then to the moon, so to speak. But they're there. They show. We'll be tracking it all the way. But this is my count. We're still in that primary B wave. What comes next, the higher it gets, the more crushing that fall is going to be. And there's enough out there to create it. And if they run this to year end, then I'm looking again that for the start of the 2024 to be a nosedive. Okay, now moving average wise, looking pretty good. On the daily, the 20 has crossed the 50. The others are following the rally. The 200, slow as a boat, but it's getting there. Our fibs are in agreement that we should continue to move higher. I would say as a minimum, we really need to get 16,327. If we can't, then this week's high at 16,173 may have completed minor wave 5, slight failure, right? Because that's 16,252, slight failure, but still small failure or not, that completed it. Now, what would I expect if that's the case? We start next week and we continue to just roll. There is no more buying. It just rolls. And it's like, get out, get out, get out, get out, get out. And it'll be a very quick trip down, forming 5 waves on an hourly chart. And then again, we're looking like it's going to break. It's going to break the 20. It's going to break the 50. It's going to break the 200 and keep on going. Because the other side of this coin would be that primary C wave down. And even if we just do simple, wherever this ends up, I can give you that we break below that low, which is 11,053, but still hold likely above the high end of 10,800. Not that much further below. There was a measurement where just below this level. And that's pretty much all it really needs to do. If we really get up into these levels and then we start to drop, right? So that means we really cruise and get into an irregular situation. Then you're looking at the fib level that is going to be governing the drop is 1.618. So then you're going 1.618. It's 1.382. Wave B over A. Wave C over A is 1.618 down. So, but again, if it gets itself up here, it's going to not look that bad. It's still going to drop down here. And then here's the kick. Here's the kick. What comes next is, because that would finish a cycle degree A wave. Whatever we end up down here, I'm looking that completes a cycle A wave, a cycle B wave. Cut away, Fed. Cut those interest rates. Give a launch to this effort in a cycle degree B wave. Counter trend rally, but still a rally that I believe will make this on a bigger scale. It's going to be a very large ABC, but it's going to cruise and it's going to go. And if we don't get to new all-time highs again here, we will very likely do it in that larger B wave, the cycle degree. All right, I'm going to go over to the S&P because this is getting pretty long. But I wanted to make sure that I went over the interest rate situation and comparing Fed funds and market moves, and what are the interest rates really doing during the market collapsing? That was the most important part. Just don't associate falling rates as bullish for stocks. It depends on really why the markets are falling. If we're into a recession or threatening a recession or going into a period of deflation, then you're looking for the interest rates to drop to stabilize things. Doesn't mean it's going to stop, doesn't mean it's going to turn and go up. Eventually, it'll reach its bottom, and then rates will continue to stabilize, and the market will march higher again. Here in the S&P, I have gone here as well. I'm going to start here again on my daily chart, and all of the givens are the same. You know, what happened to interest rates during the pandemic? Same thing applies to the S&P. But here we are. Now, I was initially labeling this as intermediate wave 1. And therefore, it has not even threatened 46.84. So could that still be the case? Yes, it can. But I'm taking into consideration that if we're really considering higher levels now that may go above 46.84, then this would be acceptable to me. I have felt that this is correct in terms of ABC, an intermediate degree. And I tried different iterations of it. I put the 3, put that as a 4. Nope, we know that 4 is not going to work because it just nosedives past this wave 1, even if it was a diagonal. It just is not going to cover it. And the diagonal here left this wave 1, this wave 4 exceeding wave 1, the starting point for, or the end point for wave 1. Not as big of a discussion because everything else fit. And wave 4 should overlap wave 1 in that. Wave 3 was not the shortest wave, et cetera, et cetera. So this really does fit cleaner. And it does work if this is intermediate wave 1. I'm showing it as an X wave, which leaves open the strong potential that we've got to do an additional ABC. Now, how we label and count, if it is indeed that an X wave, how do I want to label these internals in there? So if that's an X, that's pretty strong yet. So the only thing I may do is flip these to intermediate A, intermediate B, and we're in the intermediate C wave, which is the second ABC after this big X wave. It works, and the intensity of these rallies have been very strong. So where does that leave us? Let's just say A, B, and we're in C. Well, then these turn to minor degree waves. And this third wave, actually, I'm very in tune to likely move it up to either here or here as it just subdivided. 1, 2, 3. This is the internal. 1, 2, 3, 4. 1, 2, 3, 4, 5. That 3 actually does belong here, and I'm going to do it right now. And we'll see. We'll see if it could be wrong. And I do not think that was a 5. The market has been hanging out. It held very high level support, closed back above, well above at 45.68. It just, so maybe what we're doing now is we're inside. Right? So 1, 2, 3 internal, 4 internal, and then it subdivides again in the 5th. So if that's the case, we got a 4th wave coming. And what's our first look? Well, we're going to take it from the bottom of wave 2, and we're going to go, oh, that didn't work. Bottom of wave 2, and we're going to go up to the top of wave 3. And what we're looking at, 382, 50%. 236, it could. I mean, this has been nothing. It can't even get anywhere. Previous fourth, right there, of one lesser degree. That only takes us back to 45.40. So, and then maybe 45.14. And we get this minute, or if it's going to be a minor, we get, because these might be intermediate. So whether it's a minute 4 or minor 4, we still have this fifth wave to go. Now, how do we want to measure that out? So I'm going to take these off because we've got a lot of upside to show. And first thing I'm going to do is, again, this would have been irregular. So there's the A wave is there. I'm going to reset this and use my other. So we're just now trying to figure out, how does this all look for upside? 618 already gone, so I can readjust. We're going to take that out. Oop, here. I'm going to take that one out. So we got these left in, and we're going to say, okay. 46.39 yet again. So there we are. There's that one coming back up. So 46.40, basically. And this is 46.84. What's above? 1.618 is 48.16. So then what are we looking at in the S&P? The very strong possibility, again, if it's the double ABC, a very strong possibility that we're going to go an irregular, and in that case, I'm going to bring this back down. We're going to measure that. We're going to include our irregulars. Actually, I don't need any of those. I'm going to just go to that top side. Right, there's the 100%. Again, this is basis the December contract. That's why these numbers are going to look weird. So I have 1.618. And again, that's on this level. And where do we come in? 1.236, 53 to 55, 1.382. Those are the two should this become an irregular. So if they're really going to push this whole ABC. Are we going to get an A wave up? Intermediate wave A, a small decline in intermediate wave B, and then we get a C wave that could do that? Very possible. But we have our options here of what could happen. That's if it gets pushed to irregular. Now, let's take a peek at what it could do, because we still now have, as long as it holds below 46.84, we're not breaking any rules on whether this could be intermediate wave 1 and this ends up being a diagonal. And then we're in intermediate wave 2, which still actually, under any count, has a little bit more to go to finish. 1, 2, 3, 4. Well, you can get a 5, maybe up to 46.40. That would work. We didn't first do a 4, then we get a 5, 46.40, or hold it up, 46. As long as it doesn't go above 46.84, it remains valid. What comes next? A very nasty decline. Right? Because then if this is 1, this ends up being, again, primary B. What happens if, again, what we're looking, because we're always thinking in terms that the NASDAQ should, and the S&P should, since they share the big tech stocks, should kind of go together. Well, we get a final push. Get ourselves above 253. I'm finishing a minor fifth. It will finish anywhere above there. What do I got? 327. Okay, that works. This puts in a 5. the S&P puts in the finishing move for its wave 2, both are tipping over in a major decline. Both. Okay? Just a little bit different on the count, but the reaction or the turn would be expected from both. This would be finishing possibly a double ABC, possibly an intermediate wave 2. So we have still those choices. What I am saying also in the S&P, my longer term count, I'm still okay with it. I'm still okay with it. Yes, there were some other adjustments that could have been made that would have pulled this thing back and really been suggesting that this ABC completed something off of this count and that this was going to be a much, much larger upside wave. And the only way that I could really consider that, and it could, because it cannot be just the S&P by itself. The NASDAQ has to go with it. The Russell has to go with it. The Dow has to go with it. And they likely could, but there's other areas where it just doesn't fit. The only thing that makes it fit is that Zweig breadth thrust indicator. So dropping interest rates, I don't want to, I wouldn't combine those together saying, well, that's another reason why the market's just going to go up. So that's where we are. This is what I think. I'm going to leave all that pretty much right there. Pretty much right there. Our moving averages on our daily, we had the 20 come up and cross the 50 and the 200. That's what took place this week. So the rally really has sustained itself. And so we do have, is it an ABC? Is it a 2? And it's going to get itself up to here and not break there? Or is it going to be an extended 5th and it's really going to move itself much higher and get ourselves up here? That's really what's out there. Those are the questions. The bottom line, let me just say the bottom line for both, and just our near-term picture, I do believe that we still have upside to complete before any serious, more damaging downside kicks in. And that's where I'm going to leave this for right now. Thank you for your time. Thank you for those that have been hanging out with me and following my work. I appreciate your contributions. I appreciate you keeping me on my toes. And I love the conversation. As I've always said, I am more than up to discuss somebody else's count and as it relates to my count, any of the factors that they're including, any questions that they have. And as long as they're pertinent and sticking to subject and not condescending or disrespectful, basically. But if you want to talk about the conversation, what's really going on, I love it. The more, the merrier. I want to wish everybody a great balance of a Thanksgiving Day weekend. And also, one more thing, and if you're listening this long, God bless you. There is another major change coming. And I'm going to be doing a separate video. And I am definitively setting up, or I have set up, a Discord server. So a lot of what I do is going to flip and go through Discord. And what that means for you guys is that I intend to switch on YouTube from ad revenue to just straight, subscription to a membership site. And so I'm going to be detailing back out in a separate video what all those memberships will include. So we'll be adding a trade room. We'll be adding just the daily analysis, the big picture analysis, but more detailed into individual markets so you can pick and choose what you want. Plus we have coaching, plus we have a lot of other things. But I find it to be a better way to serve everybody, to give them more and to change a couple of things in between. So more on that coming. Thank you again. Have a great weekend. Our next update will likely be on Sunday, the Elliott Wave update on Sunday.